Welcome back, everybody. So somebody commented asking for a video about some bearish strategies they could do while the market is going down. And so that's what this video is going to be about doing. Like, what can you do during this downtrending market to hedge your positions or perhaps even make money? So in this video, we're going to be talking about a couple different strategies. We're going to be talking about covered calls, selling in the money covered calls. We're going to be talking about married puts, financed puts. We're going to talk about inverse and SPY, bear put spreads, and credit call spreads, and even bear zebras. So a lot of stuff in this video. It might go a little long, and we're going to be doing this all on the thinkorswim platform using an on-demand feature and analyze so you can see exactly what these strategies look like, and you can see what the P&L looks like, and hopefully you'll learn something new and find something that can help you during this volatile time in the market. So first off, we'll be looking at doing a covered call. And what a covered call is you promising to sell 100 shares at a specific price that you choose if the price of that stock is above that price at expiration. Now, the benefit for doing this is that you can use it to act as a hedge. Like if the stock goes down, the premium that you receive for selling the covered call will act to lower your cost basis. And then on the flip side, if you're wrong and the stock does go up, then you're selling your stock at a profit because ideally you'd be doing this above your cost basis. So it sounded very complicated, but when we look through this, hopefully it become a little bit more clear. Right now, I'm just have Tesla up. I'm not recommending Tesla, it's just what I have up right now. What we're going to do is look at 30 days out, and we're going to first buy 100 shares of Tesla. So this will be something that you have 100 shares of in order to sell a covered call. If you don't have 100 shares, then it'd be called a naked call, and, well, I don't like naked calls, and I don't think I've ever actually traded a naked call because those are scary, so if that doesn't make that clear to you, then I'm not sure what will. So this is something to do when you have 100 shares of something. Maybe you sold a put, you got assigned, and you're looking to keep those shares and kind of lower your cost basis. This is what we're going to be doing. So anyway, here's 100 shares that we have of Tesla, and I like to sell options 30 to 45 days out. You can pick whatever works best for you. Let's go ahead and look at Tesla here. And since our cost basis is going to be $8.75, what I want to do would be to sell a covered call that is at least that price or maybe higher. Just basically where I think Tesla won't go if I want to keep the shares. So I might even go up to like 30 delta, which in this case would put us at 980. Basically, this is saying that we will sell you the 100 shares that we got of Tesla at $8.75 for $9.80. So you're giving us all that profit if it did go up. And for doing that, you're giving us even more money. The downside of this is opportunity. So if Tesla did shoot up to like 1,200 during the duration of this time, then you miss out on that extra gain beyond 980. So that's the risk. You can't make money without taking on some kind of risk or some kind of loss opportunity. And in this case, that's what it is you're giving up upside potential. But since we're in a bear market, you make the choice. So anyway, this is what this looks like. When you're looking at these, you can even go right at the money and sell this one instead. I'm just going to put that on here so you can look at what that looks like on both versions here. Just so we can look at that later. If I look at the risk profile, come on, let's move this over. Maybe I'll shrink this a little bit first. Okay. Sorry, it's been a while since I've played around in thinkorswim here. So what we got now is that if Tesla does go up, our max gain becomes capped because we give away our shares at that point. And in this example, it's going to be the premium that we received. So 2,965. I'm looking at the price we got filled at, or I guess it's still moving. So basically, if Tesla went up, we make that 29.80. Plus, we bought these at 875 and we're selling them at 980. So what's the difference there? Sorry, let me look that back up. 875 to 980. That's $105. So 10500 because it's 100 shares. So if Tesla does shoot up and we have to get rid of our shares, we make quite a bit of money here. So we did end up selling Tesla. You get to keep the premium, and then the difference between what we bought it for and what we're selling it at. So in this case, we would make $13,480 if Tesla went up and we had to get rid of the shares. If Tesla stays below 950, we keep all that premium that we got regardless, and we could keep the shares. And our break even is actually lower by, well, $3,000 because that's what we bought that's what we got received for the premium that we sold the covered call for. So this would be the price of the stock right now at $8.75, and because we sold that premium, we collected $30 of extrinsic value basically. That lowers our cost basis by $30. So this is an easy way to lower your cost basis. So in this example, our break even is what, about $8.50 here. If instead we sold closer to the money for our covered call here, let me switch that over. You can see how this changes a little bit more. And now, if we're wrong and Tesla does go against us and moves up, we make a lot more money because we received $68 credit versus $29. And the result of that is that our break even is actually a lot further away from the shares as well. In fact, it's $68 lower from where it is right now. So this is where like selling a covered call can be very good in terms of like putting on a little bearish position to hedge a little bit about a stock going against you a little bit. So if you still want to hold a stock and you're afraid it's going to go down in the short term, sell a covered call. You get that extra premium, that's extra income in your pocket. You could use that to buy more shares if you want to. This would be good if you want to hold a dividend stock and you're still afraid of it going down. So it can also enhance your dividends. Like covered call, nice, easy strategy. And you still have room to manage the position as well. So like if Tesla did shoot up and you decide that you want to get rid of the calls, what you can do is you can buy to close this position for a loss. And then you can go out further in time, sell another covered call for a credit. And so you can roll that put or that call out in time so that you keep the shares and you can still participate a little bit more in that rise up if the stock does go up. But remember, we're looking at these from like a bearish perspective, and what this is doing is it's going to hedge a little bit if the stock's going to be dropping. And something they could do when you're looking at that is see how much your particular stock has dropped since SPY dropped from 410 to 390, so it dropped 20 points. What if SPY drops another 20 points? How much would your stock drop? And that might give you some ideas of how much credit you should be trying to receive to sell these covered calls. Next up, we're going... Is this broken now? Come on. Sorry about that. Next up, we're going to talk about selling an in-the-money covered call. And I'm just going to lock this in at 875 just so it stops moving on us here. If we go back to simulated trades, you can sell an in-the-money covered call. And this is a more bearish play than just selling a covered call at the money or out of the money. Because in this example, you're saying like, yeah, it's going to definitely go down. And I don't care about keeping my shares if it doesn't go down. But the result with this play is that you're collecting more premium. In this case, $115 per share. Like, that's awesome. And if the stock does go down below 800, then we just lowered our cost basis by $115 per share. Now, if it stays up, we still win, even though you're selling your shares for less, because you're collecting all this extrinsic value as well. So, and do a little math here. And we're going to say, like, Tesla stays exactly where it is, even. And why is this not working? This is kind of annoying. So if we sold the shares at 800, you know you're going to be losing about $75 per share because we bought it at 875. But we collect a lot of premium, and basically all the extrinsic value that we got for selling this is still going to be profit for us. So we collected 114 from that. So if we do the math on that, we got about $3,900 in total profit if Tesla stayed above 800. So we still make money by selling an in-the-money call. Basically, it should be about the extrinsic value that you get at the time that you sold the covered call. And we're going to go ahead and clear this real quick. Look at the risk profile. And you can see that in the money covered call, it lowers our cost basis drastically to 761, and that's because we collected so much premium for doing this. So Tesla would have to go all the way down to 761 before we start losing money on the shares of Tesla. And that's because we reduced our cost basis by 114 from what we bought it at. So that's the benefit of doing an in-the-money covered call. If you're not glued to having your shares, like if you don't mind it getting called away, then it's a great way to lower your cost basis if it does move against you drastically, or just another good way to unload 100 shares if you're just ready to get rid of them, because you can still get extrinsic value. And if the stock happens to go back down to a point that you would have bought back in, well, now you get to keep it because you lowered your cost basis drastically. And next up, we have the married put. And basically what that is just you buying protection on your shares. It's nothing too crazy. On a stock like Tesla, it would be pretty costly, so maybe not doing it on Tesla. And the further away from the money that you go on this, the cheaper it gets, but then it also takes longer for that protection to come in, so you just gotta figure out where you want that protection to kick in at. And Tesla has a lot of extrinsic value, so buying protection to the downside would be pretty costly, but we'll go ahead and throw a couple of these on. So what we're doing is we're buying a put, and you can choose to buy a put right here. Let me buy this guy. So this would be at the money. Or you can go further out of the money, get a cheaper one. Let's go ahead and just buy the 700 just to show you a difference. And if you look at the risk profile, what happens is that you're lowering your max loss on these shares because you're saying that no matter what happens, I can force someone to buy these shares at 870 in the future. So if Tesla shoots down to 500, instead of losing $375 per share, I only lose the extrinsic value that I paid here, which would be, in this case, $70 per share or $69 per share. So drastically different because you're just lowering your max loss. You're not going to make money by buying these puts, but it'll hedge in case the stock was to go down. If we were to do this guy, obviously, like, it doesn't cap your max loss until you get to 700, and then anything that Tesla drops after that doesn't really affect you because you could force someone to buy at 700. So buying a long put to go with your shares that you have can act as like a hedge for you. This is not a play that's going to make you money, but it can stop the bleed a little bit if stuff goes against you. Now, in this channel, we usually sell theta, so this is kind of going against that, but in terms of hedging, buying puts is a good way to hedge losing your skin on a stock like this. Another thing you can do is something I like to call the financed put, and that involves a covered call as well as a put. So, say you think the stock might go down, but you're not entirely sure. You just kind of want to hedge a little bit. What you can do is you can sell your covered call at whatever price you feel comfortable with. So let's say if Tesla got up to 900, I'd be fine getting out of it at 900. So I'm going to sell that call. So selling a covered call. So I collected $57 for doing that. What I can do is go on the flip side and buy a put that will act as a hedge against the stock going down. So if I buy for less than the call that I sold, then I made a couple $100 from doing it. So let's say I do the 840. So that means this is going to be done for a credit, which means I make some money overall from doing this trade. Risk profile, what happens? I limit my upside potential and my downside potential. But if the stock goes up, I can make $25.77, and that's because you'd be selling the shares for more than you bought them for, and you made a little bit of a credit from selling these two. If Tesla does shoot down, your max loss is $3,400 on this, and that's because you could force someone to buy these shares at $840 that we bought for $35 more than that, plus whatever this extra $100 from the difference here. So that's what I like to call it the finance put. I'm not sure exactly what the real term is called for this, but I'm just calling it the finance put. Sell a covered call at a level that you're fine with selling these shares at. You could use that to buy a put below your cost basis or for less than what you paid for it. All right, so the next thing they can do is you could just try to simulate the inverse of SPY. And what you can do is look at different tickers, depending on which ones you want to use. And some popular ones are actually SH. And what this guy does is it inverses the gains or losses of SPY. So if SPY, the S&P 500 is going down, this will go up by that amount. So you saw that year to date, SPY hit like negative 20% for the year. That means that this guy would be up 20% for the year. So if you want to just kind of inverse the market, think it's going to go down, you could buy shares of SH, and that'll make you money if the market goes down. If you want to try to get more money, you could buy something that simulates a 2 times move. You got some leverage stuff going on here, and this would be SDS. And basically what happens here is if SPY goes down $1, this goes up $2, or if it goes down 1%, this goes up 2%. And I guess I'm not even sure why I'm showing you the charts for these, but you can see that the movements are a little bit more bigger than what we did in the last one. And then the last one you could do is you could do the triple leverage version that tries to simulate owning the inverse of SPY times 3, and that would be SPX. And you see again, these are moving more drastically because it simulates the inverse times 3. And so if SPY goes down 1%, this goes up 3%. If SPY goes down 10%, this goes up 30%. Now these triple leverage ETFs, I mean, they're not something that you want to hold long term. They do lose value as stuff trades sideways. So if I was doing this, I'd probably stick with SH. Although for me, I'd probably stick with selling like credit call spreads or bear zebras, which we're going to go into later on in this video. Next up, we have the bear put spread. Let's go ahead and put this back to Tesla, because why not? Tesla's awesome. Go to Analyze. Sorry, I'm clicking the wrong buttons like crazy. And a bear put spread means you don't have to have the shares. And what you're doing is you're betting that the stock's going to go down, but maybe you don't have a lot of money to do it with. So I can buy the 870 strike, and then I can go up and sell the next strike up, which would be 865. And what we get here is a play that hits max profit if Tesla just gets down below this price at expiration. And you can see how this looks here. Max loss is 345. And how you get to that is that it's the difference between the strikes that you bought and sold. So in this case, 865 minus 860 is $5. Times 100 is 500. But we're receiving a net credit here, and that's why it's a little less than 500. So the result is $340 if Tesla stays where it is or goes up. If Tesla goes down below 865, then we make max profit, which would be $160. So you're risking $340 to make $160, and this is an at the money position, so you get pretty good credit for it. Like, another thing you can do, obviously, is you can increase the amount of contracts you do, depending on how much risk you want to take on. So in this case, we're risking 1,000 to make 495, about a 2-to-1. Pretty neat. But what many people would suggest if you're gonna like do more in one play here would be to widen your spread here, so you make less money. But here you go. We'll sell the 865, and then we'll go $10 up. sorry, I screwed that up. This would be a bull put spread. When you're looking at the strikes here, and you want to go bear, you need to buy the one that's closest to the money first, and then sell the one that's further out. So we'd be buying this guy, selling this guy. And again, that's $10 wide, so at most $1,000. But we're receiving a net credit here, and so that's going to lower the amount we have risked here. So our max loss is going to be $5.95. I'm looking at that blue number in the bottom left corner when I'm dragging my mouse around, so that's how I can tell quickly what the max loss is. And then if it's finishes below, $8.55, we hit max profit, and that's $450. And what this does is it gives you more options to manage it. So going wider versus having more contracts at the smaller width there is the route I would go if you want to have more money into the position. But you can find out what works for you. There's no wrong way to do the bull put or the bear put spread. I mean, it's just your flavor that you want to go with. But for me, I would go wider versus having more on that are smaller width. You can also play around with making it even more bearish by moving down here. But the further away from the money you get, the less premium you get. So in this case, you can see we're getting $1.10. So our risk profile changes drastically. See, there I go. I'm so used to doing credit spreads, I always click the wrong side when I'm doing these. Okay. We're just getting 290 to get 210. The next bearish option that we're going to be looking at is the call credit spread. You might see this called the bear call spread. And what this means is that you're selling a call option and then buying one further out of the money. This is what I tend to do instead of doing naked calls when I am going to use a call spread to bet that the stock's going to go down. Now, what you're doing is you want to pick a spot where you think the stock's not going to go. So if you think it's only going to go down, you can sell at the money, but your delta is going to kind of tell you your percent chance of being right. So this has a 47% chance of being right. It's 1 minus the delta here. What I would say is try to get a lower delta so that your percent chance of being wrong is lower. I mean, at the closest I would probably go would be 30 delta, which means 70% of the time you're going to be successful on this one. But might even go further than that, depending on what I look at for the chart, basically. And in this case, let's go ahead and just do the 50 delta, or 15 delta. So I'm going to sell this guy, and then we'll go further out. So if I go just one strike lower. Now, when you're going out of the money options here, it's going to look really bad here on the on demand because you're giving up all the money to the spread. But if we actually look at the fill price here and take midpoint, this might be, what, 1160? We'll update that. And then this guy might get filled at $11. And basically what we're doing is the money that we receive as a credit is our max gain for this position. So 1160 minus the $11 we're paying out is 60. So we might make $60 as long as Tesla stays below 1070, which is pretty good. If we look at the risk profile, you're going to see it's actually going to reflect that. All right, so if you look at this, if it stays below 1060, or sorry, 1070, we get max profit, which is $60. But if we're wrong, we lose 440. And again, same thing like the puts that we talked about. The difference between here is 500. We receive 60, so that's where you get the 540 from, or the 440 from. And that's what the bear call spread is. If you don't buy the call that's further out of the money, what you have is a naked call, which means that if Tesla does for some reason shoot up to 1400, well, you have to buy 100 shares at 1400, and if you don't have that money, that's some pretty big losses. Basically, you have unlimited loss to the upside if you do a naked call. And I don't know about you, but seeing those numbers are pretty scary to me, which is why I always try to limit my max loss. So when I'm selling calls, I usually buy one that's further out of the money to make it a call spread. so that my max loss is defined if for some reason I'm wrong. And again, similar to the bull put spread, instead of putting on multiple contracts, what I would look at doing would be going further out. So say I really think 1070 is really safe. Maybe I'm fine with risking 2,000 on this. So I'm willing to buy one that's further out of the money. So say 1090 here. We buy this guy, mid price is 925. Go to the risk profile. Take away the one that we're not looking at. And you can see our max profit on this trade is higher now because we receive a bigger credit. 1160 minus 925 is 235. But our max loss is increased if we're wrong. But remember, this is a 15 delta, so 85% of the time this should be successful. Although our max loss is going to be a lot higher because we went 20 wide, and that's 1765. I like the call spreads. I really do. When I do want to go bearish, that's a good way to do it. The last thing that I said I would talk about would be the bear zebra. And really, you should watch my zebra video to get a better understanding of these. But these guys, I tend to do 45 days out. And I think the video that I did it on uses calls, but if you do with puts, it becomes a bearish play. And it simulates being short 100 shares of the stock, but it has a max defined loss. So in this case, you sell it at the money. So looks like it Tesla went down to 863 while we've been doing this video on this on-demand feature. We sell this guy. You look at the extrinsic value of that option, and you try to find an option where times 2 equals that. So 83 divided by 2 is about 40. We're looking for about 40. Looks like this could be 975 here. We'll buy 2 of these guys. And basically what this is doing is it's creating a play that simulates being short 100 shares. Theta should be a non-factor, so you're not betting against theta. Actually, in this case, it looks like theta would be ever so slightly in our favor. But let's go ahead and look at this guy. This goes to June. And what happens is that for every dollar that Tesla goes down from where it is now, we make $100. It goes down to 800, we make $6,600 because that's $60. If Tesla moves against us, this is where it's really neat. So instead of shorting the shares, our loss is going to be capped off at expiration. We're looking at the blue line first here, to being the money that we put in to buy this, to put on this trade. So that's 22,000 in this case. If we're short 100 shares and Tesla shot up, you saw earlier what kind of happens. Like, we have unlimited loss to the upside. But with the zebras, it's capped off. But on top of that, what's really neat about this is that it loses slower than a short, being a short position would be. The pink line is how much you'd be losing as time moves. So in this case, this is 513. We're looking at 5.2 here, so let's go ahead and switch this guy real quick. Say Tesla went up to 1,000, we'd only be down 10,000 looking at that pink line if this happens on the day that we put it on. If this happens a week after we put it on, or let's just say 510, which is like, what, 7 days later, we'd only be down 11,000. Like, we have time to manage this position before we hit that blue line. Now, as time goes on and the pink line basically races to get to that blue spot. But what you're saying is that you just have time to get out. So even though the blue line shows you your max loss, like, it takes a while to get to that with these zebras, which is what is really cool. But at the same time, if you look at the profit potential to the left, that stays virtually the same. So if the stock moves in your favor at any point, you can shut it down for a gain. That's why I love these zebras. It's a lot safer than being short 100 shares, which I guess we might as well show you what that looks like. So you'd sell 100 shares. Let's go back to the risk profile. Take these guys off. And you can see, like, every dollar that goes up, you lose $100 very quickly. So, I mean, I don't know. if you want to short shares, I think doing it through options is safer because of that. I don't know, but you do you. I mean, whatever you're more comfortable with is what you want to do. So, holy cow, we just talked about a lot of stuff here. I hope you guys learned something new. Maybe it gave you something to look into. If you have any questions, go ahead and leave a comment below. If you want to talk about it, see me on Discord. Join the server. You can DM me and we can talk about the option strategies if you want to talk about them. I love talking people through stuff. So, hope you guys enjoyed this video. If you did, like it, share it, and I'll see you guys next time.